Well, inflation is too high. Let's start with that. Now, we think we've seen possibly this week, the first glimmer that with the figures that were released this week, that it's not only beginning to come down, but it was a little bit below where we thought it would be, and that's obviously very good news, but there's a long way to go. And and we expect that to happen, by the way. We expect inflation to start falling more rapidly, probably from the late spring onwards. But there is a risk that it won't happen in that way, particularly because the labour market and the labour supply in this country is so tight. And that's why really we had to raise interest rates today, because we see that risk as really quite pronounced. I think there are a combination of drivers. So more of the drivers have been external. Obviously the war in Ukraine is having an effect, a very big effect on energy prices and on food prices as well. We've seen disruptions in supply chains around the world. Now, we're seeing some of that starting to ease off, I would say. I think the supply chain issues are starting to ease off. So it's a combination of shocks going on. There's a domestic shock in terms of the labour force, but there are some very big external shocks that have been hitting the economy and causing inflation to be higher. Well, I'm not going to speculate on where rates will end up because that really does depend on how things unfold. What I would say is that I think, in terms of, you look at the history of the Bank of England's, history of the Monetary Policy Committee, a 0.5% rise is still a very big one. I mean, we only did the first 0.5% rise earlier this year, so I would put it into that context. And we will have to judge, as we will do, in a few weeks' time when we have the next meeting, what's appropriate next time. So I'm not going to speculate on where they may end up or what we might do next time at this stage, because there will be a lot of information that we'll get before we get to that point.